Now, 12 weeks have passed since Kenya held its general elections in August. Since then, over $1.3 billion of value has been wiped off the market capitalization at the Nairobi Securities Exchange. Whereas in past elections, there's usually a decline in general consumption and investment, 2017 has been much worse. We're here, CGTN's Ramah Nyang explaining why.
On October 24th, a private sector lobby group estimated losses attributable to this election at just under $7 billion. Now, to put that into context, that's almost as much as all of Kenya's borrowing, foreign and domestic, in its last fiscal year, which ended in June. GDP and employment data for the second half of 2017, in fact for the entire year, won't really be out for another couple of months, but the leading economic indicators do point to a slow train wreck of a disaster. Take, for example, the Stanbic Market PMI Index. It contracted briefly early in the first quarter for the first time in series history, which goes back to 2014. It has, however, been stuck in contraction territory all the way from May. At that point in time, it was just under 50 points. But by September, when the Supreme Court nullified the result of the August 8 presidential poll, it was at 40.9 points. Now, three key things do stand out here. For one, employment in the private sector and the volume of new orders have declined for 2 straight months in August and September back to back. New export orders, they've also fallen for the first time in 3 years as international demand for goods and services has fallen. Now, companies are running down inventories instead of spending cash, acquiring new ones, or even maintaining existing levels. And a survey from the Manufacturers Association out October 19th, in fact, did point out that 53% of their members plan to make absolutely no new capital investments in the next 6 months. 31% will keep their staff headcount at current levels. But this is a really scary number. 47% of them either are or will be reducing their existing staff. Now, manufacturing as a whole accounts for just about 3% of total employment in the country, nearly 80,000 direct jobs going by end 2016 employment data. But perhaps the most glaring data point that points to the steep decline we're looking at in economic activity is this: fuel consumption, which powers most logistics in the country, from public transport to moving goods in and out of the port of Mombasa. On a year-on-year basis, Kenyans used about 14% less diesel, 15% less gasoline. Now, the trend line for consumption is just as alarming, since this basically shows just how big a dip we had here. This is 2017 in orange. That just shows how big a dip in consumption we had in July, just before we get to the polls in August, across all categories: diesel, gasoline, kerosene, you name it. In short, therefore, by whatever data point you look at, Kenya's 2017 election has inflicted a very steep cost on those who can least afford it.